As usual, give a couple minutes to people as they log in, and we'll get started in about 2 minutes. So thanks for being here. Hello, welcome. I see people pouring in the room. Nice to see everyone. Nice to see so many signed up. Thank you. And hi, good morning. We're just waiting for giving people another minute to log in, and then we're going to get started. Sure, my phone is off. Good morning. Thanks for being here with us today. As usual, we're just going to give people time to log in. Everyone kind of runs in on the hour, so we're just going to begin in another minute, and we're going to get started. Good morning. Just another minute, we'll get started. Welcome. A few more people. Good morning. Thanks for being here. Welcome. As you're entering the chat, we're going to get started shortly. Okay, so we are going to begin. Again, welcome. I know there are people still entering in the webinar, but we're gonna get going. So today we're happy to welcome Jason Hwang, who is going to share both economic data and his expert perspective on the economy as we navigate 2025. So in a year marked by a great deal of volatility, mixed economic indicators, inflation concerns, GDP decline, escalating trade and tariffs, trade war and tariffs, and then the consumer confidence and response to all of the above. Jason's analysis today is going to be very helpful in understanding the challenges and opportunities that lie ahead. With that, I'm going to introduce Jason to all of you. Jason Hwang is a Senior Vice President of Strategic Planning and Research at Federal Home Loan Bank of Boston. He oversees the bank's strategic planning process and provides management and the board of directors with financial forecasts and assessments of strategic opportunities. Prior to his current role, Jason directed product development and assisted bank members with funding strategies. Jason holds a PhD in economics from Harvard University, and he speaks frequently on the economy and the FHLBB Bank of Boston throughout New England. As far as today's format, following Jason's presentation, we do have time set aside for a Q&A, but Jason did say if you have questions during the presentation, he's happy to answer them. You can send those questions to us in a chat, me or Jason, I'll be monitoring. And then the other option is you can raise your hand, I can unmute you, and you can ask the question yourself. And with that, we warmly welcome Jason. I'm going to turn it over to him so he can guide us through the economic outlook for 2025. Oh, Jason, let me unmute you. Hang on.
Oh.
There you go. Done.
Great. Thank you, Erica. Hey, good morning, everyone. Thank you so much for the introduction, Erica. Great to join you this morning. I'll share my slides here. Okay. Well, let me start with the title of the presentation here. When I was invited to discuss the economy at this meeting, it was before Liberation Day. And then Liberation Day happened at the beginning of April. And then, as you might imagine, all of the economic outlooks and projections people had sort of went out the window and had to form new outlooks and projections subject to a lot of uncertainty. So I think that is a theme for economic discussions right now. So let's definitely review the most up-to-date data that we do have and then see what they tell us, knowing that there's a tremendous amount of uncertainty about projections for the remainder of the year and going beyond. So, okay, so let me start with kind of key takeaways. I like to start my presentations with some key messages that I think are kind of the takeaways for us. Starting with the labor market. Labor market is solid if you look at the levels of the data that we have, but there is a trend that is more concerning, which is a softening, cooling trend. So that's the summary on the labor market. Consumer spending is strong. That's really important because consumer spending drives GDP, economic output. So it's good to see that consumer spending remains robust. But if you ask people about consumer confidence about the economy going forward, that has really plummeted in recent weeks and months. So we'll take a look at that and see what that might tell us about economic output going forward. Inflation is, of course, a focus of the Fed, and inflation is now very close to the Fed's target of 2% per year. There is one sector of the economy where inflation remains a challenge, and that is the housing sector. And we'll talk about how the inflation problem in some ways has been solved in many sectors of the economy outside of housing, but housing continues to be a challenge for us. GDP, we'll talk about the first quarter where we saw a contraction in GDP, but the most current kind of real-time forecast we're getting a month and a half into the second quarter is that we may be seeing a 2 to 3% growth in the second quarter, which is a sort of healthy number, but we'll talk about whether that's likely, what might be some downward risks to that projection for this quarter. And then, of course, we'll have some comments to make about how much uncertainty there is about trade policy and potential impact on the economy. Okay, so those are the topics today and some key takeaways. Let's go through each of those topics here. Let's start with the labor market. Okay, here's a chart showing the unemployment rate, and this is, of course, a key summary statistic. And here we're at 4.2% unemployment in April, and that is a healthy number. 4.2, historically speaking, is a low unemployment rate. But there's a trend here. If you look at this over the past year, past 2 years, we've seen an uptick in the unemployment rate rising from 3.5% or a little below to where it is now 4.2. So the trend here is what we're watching to see whether there is further deterioration in unemployment rate. But the level itself of 4.2 is a relatively low unemployment rate. Now, here's another chart that shows a similar pattern here. This is the job opening rate. This is out of total employment, total jobs in the US. How many of those jobs are open and firms are making active recruiting efforts to hire into those roles. And what you see here is that a couple of years ago, we were at 6.5%. Out of 100 jobs, 6.5 were open and firms were looking to hire. And that number has come down over the past couple of years. And as of March 2025, the most recent data, we're now at a 4.5. So here, the 4.5% is not a bad job opening rate. But the trend here is what I think we should watch carefully, because the job opening rate has come down. So this means that firms are a little bit more cautious in recruiting, posting new jobs. So again, there's the level story and a trend that is consistent with a softening labor market. Here's another data point that's similar to the previous chart. This is a data that comes out of a website called Indeed.com that posts job postings. And the way this data works is the lines are indexed so that the horizontal line for 100, that means how many job postings we had as of February 1st, 2020. So beginning of February 2020. When is that? That's right before COVID. So you can think of this as the horizontal line representing 100. That's the labor market that we had just before COVID in early 2020. And that was a strong labor market. Well, people thought that we were close to maximum employment using Fed speak just before the pandemic. So 100 represents a pretty strong labor market. And what's remarkable here is that compared to where we were before COVID, in 2023, even in 2024, early part of 2024, we had far more job openings, job postings on this one particular website, Indeed.com, compared to where we were before the pandemic. So a very strong labor market, lots of jobs out there, firms are making recruiting efforts. But the thing here to notice is the trend. The trend over the past 2 years is a declining trend. The number of job postings has declined. And it's interesting, if you compare, again, the 100 index here is a comparison to the pre-pandemic level. And what's interesting, if you look at the nation as a whole, that's the blue line for the US, we're still a little bit above, maybe 10% or so, a little less than 10% above where we were pre-pandemic. So the job market, arguably, you could say, is a little bit stronger than we had before the pandemic, but with a declining trend. That story changes, though, if you focus on just one state, let's say Massachusetts, our state, which is represented by the red line. So this says that as of 2 years ago, in 2025, we had many more jobs, 20, 30% higher than before the pandemic. And then we've seen a decline in the number of job postings. And then in the latter part of 2024, say the fourth quarter, we actually came in below the 100 horizontal line here, which means we now have fewer job postings than we did back in February of 2020. And that decline has continued. And so we're now a little bit below like 90% of where we were before the pandemic. So the job postings have definitely decreased. And I think this is a sort of a softening labor market trend, especially in our state in recent months and years. Okay, so that's the job posting data here. Let's look at some other data. This is for the nation as a whole, for the US. Initial unemployment insurance claims. So this is a number of people who are filing claims for unemployment insurance for the first time. So the Bureau of Labor Statistics tracks continuing claims, folks who are coming back and saying, hey, I'm still unemployed. I'd like to file for unemployment insurance on an ongoing basis. That's one metric. But this is initial, like new people who are coming in and making claims. And folks consider this to be an indicator of layoffs or involuntary job losses. And so if there's a sort of an uptick in here in this metric, that would be consistent with a growing number of job losses, layoffs, and so on. So looking at this over the past 2 years, I'm not seeing a big trend here. I think where we are now, especially given the scale that's represented on the vertical axis, I think there is not sort of a big uptick in the number of layoffs and number of people that are filing for unemployment insurance. Arguably, you could look over the past year and see maybe there's a little bit of an uptick here, but I think over a 2-year period, we're about where we've been. So I'm not seeing a big increase in unemployment insurance claims. Okay, what about quit rate? Now, this is an interesting metric. This is a voluntary quit rate. This is out of 100 people. How many people are voluntarily separating from their jobs, leaving their workplace? And a higher number is a good number. A strong labor market means that folks are voluntarily leaving their place of employment presumably because there are better opportunities elsewhere, higher pay, promotions that might be available elsewhere. And so when the economy is very strong, labor market is strong, this metric records a higher number. And we've seen a decline here, which means that folks are staying put. Folks are less likely to leave their jobs voluntarily, which is consistent with a softening labor market. If the outlook isn't as great, then you're less likely to leave your place of employment, look for opportunities elsewhere. And so we've seen a decline in the previous 2 quarters. Maybe there's a little bit of a reversal, but overall, this is a declining trend consistent with a softening in the labor market. So both on the supply side, in terms of folks who are supplying labor, there's a softening pattern here. On the demand side of firms recruiting, we've seen a softening in terms of job postings, job openings. And so on both sides of the market, it appears that I think there's a clear pattern of a cooling labor market here. What about labor force participation rate? So this is out of civilian population, how many people are in the labor force actively employed and working or unemployed and looking for work? So that's the metric here. The blue line is for the whole civilian population, and then the red line is for 25 to 54-year-olds. We expect that the participation rate is going to be higher for 25 to 54-year-olds, and as you can see here, that's the right axis. So out of 100 people, we have 84 of 25 to 54-year-olds in the labor force. So that's good. And we've seen an uptake. We've seen a positive trend here since we came out of the pandemic. We've seen a sort of positive trend in the red line. The blue line is for all ages, not just 25 to 54. And so here I'm seeing a flat pattern and maybe even a little bit of a decline in the labor force participation rate. So I think this is a trend worth watching here. Folks drop out of the labor force when there's discouragement, when they feel that the labor market prospects are not very good, they drop out of labor force altogether. They stop looking for work. Well, if you stop looking for work, then you're not even unemployed. Then you're out of the labor force altogether. So that's a sort of a troubling pattern. consistent with a deterioration in the labor market. I'm not really seeing it here too much. I would look at the blue line and say it's kind of relatively flat over the past 2 years. But if you, depending on kind of which point you focus on, maybe there's a slight decline. It's not very pronounced right now. So I think there's a sort of pattern here that we need to watch to see whether there's any deterioration in this metric. Okay, so those are labor market indicators on the demand side from firms recruiting and the supply side of folks being in the labor force and working. The result of sort of the demand and supply side is reflected in the wage growth rate. How fast are wages rising? In a very strong, tight labor market, we would expect wages to rise faster. And here we see that in the most recent data points, early 2025, wages are rising a little above 4% on an annual basis. So that's again, a relatively strong number here, but we've seen a decline in the rate of growth in wages. And that's also consistent with sort of the drop in inflation also. So there's not as big of a pressure on wages having to increase as a result of the cost of living increases. But there's been a softening in the rate of wage growth, but it's still above 4%. That's still a pretty high rate of increase in wages. And we'll talk about this when we get to consumer price inflation. If wages are high, growing at a fast rate, then that could impact consumer prices, especially in sectors where wages are the dominant input, dominant factor of production. And then the rapid growth in wages could translate into inflationary pressures on goods prices or services prices. And so that's something that we'll talk about also as well. Okay, so that's a quick review of labor market statistics for the U.S. Let's talk briefly about our area, New England and Massachusetts briefly. So we talked about the levels being reasonably strong, but with a declining trend, and that holds for Massachusetts and New England as well. Looking at unemployment rates, comparing year over year 2024 and the most recent data point from March, we see relatively flat, maybe a slight uptick in unemployment rates, but relatively flat here over the past year. And if you look at levels, some states still have very low unemployment rates. Even for Massachusetts, 4.4, relatively speaking, historically, that's a low unemployment rate. And so levels look okay, but what about trends? Okay, so labor force participation rate. So this is for all ages in the state of Massachusetts. We've seen a positive trend, and here more folks are in the labor force, either working or if they're unemployed, they're looking for work. And so I think that's a positive trend. Folks are staying in the labor force, and the rate of labor force participation seems to be rising. So I see that as a positive sign. What about folks who are filing for unemployment insurance? So we saw this metric for the U.S., and now this is for Massachusetts only. And the number of folks who are filing unemployment insurance claims for the first time, initial claims, I would look at this and say there's a little bit of an uptick here compared to sort of where we were 2023. And if you look at where we are now, there's some seasonality here. But if you look at sort of what the numbers look like, it looks like we've seen a little bit of an increase in the number of people who are filing unemployment insurance claims. So there is a little bit of a sign here that maybe there's a softening of the labor market. Are we seeing more layoffs in Massachusetts relative to the rest of the nation? Because we didn't see this trend for the U.S. as a whole, but we're seeing a trend here for the U.S. for Massachusetts. So maybe there's a trend here that we need to watch for our state more carefully. Okay, what about some other trends here? So here's a trend for two areas of Massachusetts, the two most populous and most important areas in terms of job growth, the Boston metro area and the Worcester metro area. And what the red line is tracking is year-over-year changes in employment. So if it's positive, that means we have more jobs now than we did a year ago. If it's negative, that means we have fewer jobs than we had a year ago. So that's a growth rate in jobs. So looking at the red line here, what you see is that we've seen a decline in the rate of job growth in the Boston metro area. And actually, if you look at kind of the early part of 2025, we're either at zero or we're negative, meaning we have fewer jobs now in the Boston metro area than we did a year ago. So that's a little surprising. When I saw this, that was a little bit of a surprise to me. I expect job growth in Massachusetts. There's no recession here. I expect job growth in the state and in the U.S. And for the U.S., which is this dashed line here, we've seen softening, but still we're adding jobs year over year. So that's kind of what I would expect. I would have expected a similar pattern for Massachusetts also, but I was a little bit surprised to find that for the Boston area, for the Worcester area also, that in early 2025, we're actually in a little bit of a negative territory. Not a big number here. I would call this pretty flat because this is, we're talking negative 0.2, negative 0.1 type growth rates. However, it is the case that these we're at either zero or negative. And so that definitely concerns me a little. I hope that this reverses. I hope that we get back into a positive territory here on job growth rates. But that is something that I think warrants a careful attention for the Massachusetts economy. Okay. If you look at job growth year over year, so as of March 2025, if you sort of look at the data by sector, here's what the job growth rates look like year over year by sector here. So in most sectors in Massachusetts, we've seen a decrease in employment, particularly pronounced in professional business services and leisure and hospitality, where the number of jobs declined by 5% or higher in those two sectors. And leisure and hospitality in particular is a big employer. Many people work in that sector. The very important sector for Massachusetts, especially, is education and health. Lots and lots that employs many people, and also those are high-paying jobs. So very important for sort of output of the Massachusetts economy. And we've seen a big increase in that sector. So that increase really helped us offset some of this decline in the other sectors here. And that's I guess some good news there. But across the board in the other sectors, we've seen a bit of a decline. So this is something that I think will be very important for the Massachusetts economy, whether this trend continues or reverses. Okay, those are my comments on the labor market. Levels tell one story, trends are different, and there's a softening, cooling trend, particularly so in Massachusetts. And so that's kind of what we're focused on. Let's turn now to GDP. So here we have GDP growth rates on a quarterly basis, annualized. And prior to Q1, we had pretty strong growth, roughly 2%, even a little bit higher, 2% growth in real GDP. And that's a strong number, strong rate of growth for an economy as big as the US. The fact that we're able to continue to sustain that growth is great. We did see a contraction, a negative 3% decline in GDP in the first quarter. I think this is very noisy data here. There was a dramatic increase in imports. Imports should not impact GDP because GDP by definition is gross domestic product. It's how much is produced domestically. Imports by definition are produced elsewhere, not domestically. So imports really shouldn't impact GDP at all. The reason why imports show up in the formula for GDP is because consumption and business investment includes consumption of imported goods, investment of imported goods. And then we want to just subtract that out. We want to neutralize the GDP metric from imports. So we're just subtracting out imports. And that's why the formula for GDP usually is like C plus G, plus, I, business investment minus net exports. But imports are neutral and should just wash out of the formula. And then, but economists studying this think that there's a timing issue here. There were lots of imports as a result of sort of the tariff policy, and folks are trying to sort of accumulate inventories and sort of buy things from overseas producers ahead of the tariffs coming into effect. But then there's a timing mismatch in terms of how quickly that gets captured in import statistics versus consumption and investment. And that's why we saw sort of a negative number here. But if you look at recent commentary from Fed officials, they think that the underlying economy is still strong. We're not really in recession yet, and that this may well reverse itself in the second quarter. Okay, so what do we focus on in terms of underlying strength of the economy? So I focus on really just one thing, which I think is the most important factor that drives GDP, which is household consumption. Household consumption is maybe 2/3, a little bit less of overall GDP. So it really drives national output. And all of household consumption, I focus on durable goods. These are our household spending on automobiles, household appliances, furniture, sort of things that cost a lot when we make those purchases. And those are the items we pull back on if we think there's a recession coming, if we think our labor market prospects aren't as great, my job is at risk, then those are the types of things we pull back on. So the durable goods spending is pretty sensitive to economic conditions. So I'm looking at this asking, okay, how robust is household consumption on durable goods? And here, through March of 2025, this is looking pretty good. Year-over-year changes in durable goods spending is robust. And that tells me there's underlying strength to the economy, and I take that as a positive sign here. This could change, of course, but at least through March, things look pretty positive. Here's another sort of metric related to this, which is number of automobiles sold. And so this is a kind of an important metric. Folks become less reluctant to buy new cars. They switch from new cars to used cars, or buying a new car to not buying at all. Those are some of the decisions that get made if folks do not feel good about the economy. But through March of 2025, automobile sales are very strong. So that's consistent with a underlying strength in the labor market. Retail sales through March of 2025, and this tracks year-over-year growth. Again, I'm looking for, are there signs that households are pulling back on spending because they're concerns about the economy? And here, there's no sign of that happening here. So again, this looks pretty good. In terms of forward-looking metrics, so we think about what's national output likely to be going forward. People ask, hey, what are some forward-looking indicators that could tell us a little bit of what economic activity might be like? Well, one is orders of durable goods. So orders come in to manufacturing companies, and it takes time to produce those goods, get them to consumers. And by the time consumers actually make the purchases, then it'll be sometime down the road. And if current orders are strong, then likely that's a good sign for some element of consumption down the road. So that's why it's considered a forward-looking indicator. And here, it looks like there's a positive sign here that as of March 2025, there's a pretty dramatic increase in orders of durable goods from manufacturing companies in the U.S. So that, again, seems consistent with a positive underlying sign for GDP. Okay, so the data that we just ran through quickly, which were all about household consumption in the durable sector. I focused on automobiles as one example, but durable goods in general, things look pretty positive there. Positive sign on orders of manufactured goods that'll result in production and GDP down the road. That looks pretty good.
Jason, I just wanted to interrupt with a question, if I could.
Yes, please.
So, someone had asked, could the auto sales be up because people are buying before tariffs?
Okay, so that's an excellent question.
Thank you.
So could this be because, oh my goodness, we're about to have these huge tariffs on Canada. A lot of cars are, made in Canada and imported here. Lots of cars made in Mexico, imported into the U.S., Japan, Europe, and so worrying that that we might see those tariffs coming into effect. Folks are making their purchases ahead of that. I think that's got to be part of the story here. And when we come to CPI, one question is CPI numbers for April looked really good, very low inflation rates in CPI, despite Liberation Day and tariffs going up. Compared to before in April. Why was inflation so low there? And one thing that folks are noting is that a lot of goods purchased in April were done ahead of the tariffs coming into effect. And so folks were ordering things before the tariffs were there. And so I think we're seeing sort of the impacts of folks kind of preemptively making decisions and to sort of avoid the tariffs, both on the consumption side and also on the inflation side as well. I think that's reflected in here. Okay, so the final comment here was that this is a concern. Consumer confidence. If you ask people, and this is the most recent data point is March, how do you feel about the economy for the next year? We did see a big drop-off in confidence about the strength of the economy, according to this one metric. The drop-off is very dramatic here, and this is getting us closer to sort of like pandemic level concerns and fears about the economy. I would think that just given the volatility and how quickly the news cycle is changing, and even what the administration is announcing in terms of trade deals getting done, I expect that there'll be a lot of volatility in this metric. If you ask people today, how do you feel about the economy today? I expect the answer could be quite different than how people felt right after, like, say, Liberation Day. And so I do want to watch this, what this says about, folks' likelihood of continuing to spend, supporting the robust economic growth. That'll be a kind of key question for GDP going forward here. So, okay, that's it on GDP. And let me turn to inflation here. So this is key. Drives Fed policy, drives interest rate policy, which of course impacts all of you, impacts us at the Federal Home Loan Bank. So how is inflation looking here? And a quick key question that no one really knows the answers to is, how will the tariff situation be resolved? And what will the impact be on inflation? No one really knows there. I'll just provide some thoughts on that here, just a general perspective, but I'll just kind of start with review of current data. So CPI is the blue line. PCE is the other inflation metric that the Fed focuses on, is the red line. We have inflation data on CPI through April, and then inflation on PCE through March. So, and then the horizontal axis is 2%, and that's the Fed's target. And we're trying to get the red line, which is the metric that the Fed focuses on, all the way down to the horizontal axis here. And as you can see, we're pretty close. We're at 2.3, 2.4, and the target is 2. So we're getting pretty close. The one extra month of data that we just got for the month of April on CPI was positive. We actually saw a further decline in the price level. The inflation rate. And so that was positive. So where are we in this fight against inflation here? And I think this is a very informative chart. Inflation consists of price increases across goods and services. So we consume goods, we consume services, and the CPI, PC is just an aggregation of prices of our consumption basket. Here I've broken out CPI into goods, durable goods, non-durable goods, and those are the blue line and the red line, and services, which is in the green line here. And then I've sort of plotted on the horizontal dash line. That's the Fed's target. And what you see here is that we have two very different stories. If you look at the goods sector, durable goods and non-durable goods, and you track their inflation rates, there is no inflation there. We're well below the dashed green line representing Fed target. And in fact, we're actually close to zero. And if you look at the blue line, which is the durable goods sector, we've been below the zero horizontal axis, meaning we've seen deflation in the durable goods sector over the past 2 years. The red line, the non-durable goods, we're at about zero. So it looks like, at least currently, there's no inflation there. And both, of course, well below the 2% target. And where inflation persists is really in the services sector. So there's a really different story here on goods versus services. And the problem really lies in the services sector here. So I want to talk about that a little bit more. Let's look at durable goods. Why is it that we've done so well in durable goods inflation? So here I have three most important elements of the durable goods sector: new cars, new vehicles, used cars, and household furnishings and operations, including things like appliances, washers, dryers, refrigerators, that sort of thing. And these things make up the bulk of our durable goods spending by households. And if you look at the inflation rates of those, then here we see that for a bulk of the past 2 years, red line has been negative, meaning the inflation rate of used cars has been negative. There was a big increase in used car prices during the pandemic, and that was sort of undone over the past 2 years. So that was positive in terms of reducing the inflation rate. And then new car prices, which is the blue line here. The blue line was positive above kind of Fed target, and then it came in below. It fell below the Fed target in 2024 and was a little bit under zero, meaning new car prices were falling a little bit throughout 2024 here, and then it's relatively flat currently. So we're not seeing any big increases in new car prices relative to where they were a year ago. And then household furnishings, we had higher inflation rates in 2023, and that declined similar to new car prices, and that we're now at either the Fed's target of 2% or a little bit below in that sector as well. So here the story is really positive. The inflation rates that were very high during the pandemic came down as the Fed kind of kept their interest rates higher, and then we've sort of achieved kind of Fed's target and even below that. Okay, that's the story on durable goods. What about non-durable goods? So non-durable goods, food is a big element, and then non-durable goods outside of food, such as clothing and other items, are tracked in red line for food, and then other items other than food in the blue line. So here, again, big inflation rates earlier in 2023, we've seen a consistent decline, and food prices are now close to Fed target. And then non-durables outside of food are actually either zero or even falling in prices. That's helping us bringing overall inflation down. So here, again, a positive story. I just included this chart here because the price of eggs has gotten a lot of attention. It's in the press often. And so I have a category here that includes not just eggs, but meats, poultry, fish, and eggs. So it's an important kind of food category overall. And here what we've seen is that we did have a very sharp increase in kind of the price of these food categories. There's a lot of attention paid to the most recent data point where there was a drop. There was a decrease in inflation rate for this category in the month of April. That's what's shown here. But if you look at sort of what's been happening overall, we've seen still a pretty big increase in the price of eggs. And there was a little bit of a reversal in April, but not nearly enough to sort of make up for the big increase in prices over the past year or so. So, okay, let me get through the rest of the inflation data here. So the point has been when you separate out goods versus services, we do not have an inflation problem in goods. The problem is really concentrated in the services sector. So here, again, the horizontal line is a 2% Fed target. And what you have here in blue is services other than housing. And then red line is the inflation rate of housing services, which is called rent of shelter for both homeowners and renters. And that's shown here. And these categories are really important in CPI. We consume more in services than we do in goods. And so services inflation will impact overall CPI more than goods inflation. And so what happens here is really important. And if we want to really, get to the Fed's target of 2%, it's important that services inflation decline to get us there. And so let's take a look at some of the details in services. Here we're looking at housing rent index. Rent index is a difficult thing to track. If you ask people, hey, how much is your rent? That rent might have been negotiated in a lease that was signed a year ago. And so we're really looking at data from a year ago, which is out there. It doesn't tell us what's happening with current prices. So to adjust for that, people look at different data. Zillow is one company that produces what they call observed rent index, and it's supposed to track newly signed leases only, not just not all leases, many of which were negotiated a year ago, 2 years ago, giving us kind of outdated prices. They try to sort of adjust for that and give us a more cleaner measure of current rent. And what they're showing is that current rent is rising at about between 3 and 4%. So if this gets reflected in CPI with time, then it says that we may have a little bit of trouble here bringing this metric down to 2%, because this is between 3 and 4. And if you look at trend in this index over the past year or so, there's a slight increase. So we were right at 3, and then we're now at like 3.5. And if that positive trend continues, this is going to do the opposite of what the Fed would want to see happen here in terms of bringing services inflation down. Here are other services categories. So outside of housing, what are the other big categories in terms of services? Well, there's medical care, medical services in blue. That's a major category. And then transportation services. That's also a category that's important. Airfare is included in there, and other services, things like auto repairs. So the blue line was a major contributor to inflation. As you can see here, very high rates of inflation over time. In 2025, though, we made some pretty significant progress. very dramatic decrease in inflation rates in these sectors in 2025. So the takeaway here is goods prices were in a pretty good place. Services is where the inflation problem is, and within services, it's really housing. We really need housing prices to come down or increase at a slower rate for us to really make progress with the final mile of bringing inflation down to 2%. Okay, so that's my update on inflation there. Let me turn to housing market and then overall sort of projections and sort of comments on trade policy going forward. Housing market. So this is rate of increase in home prices. So the blue and the red lines are the FHFA home price indices for the U.S. in blue and the Massachusetts in red. And we can see here as of the fourth quarter of 2024, we're still seeing kind of robust increases higher than 5%, 6% a year in the U.S. and Massachusetts. We have more recent data through February based on this S&P Case-Shiller index for the Boston area, and we're seeing 6% growth in home prices. So still relatively strong labor market here from the perspective of home price appreciation. One thing that we are seeing a bit of a change in is the amount of inventory available. For the U.S. as a whole, if you look at the number of active listing counts, we have seen a pretty meaningful increase in the number of homes available on the market. So that's the blue line here. If you ignore kind of the seasonality, if you just track the trends over time, there's clearly a positive trend. On the left axis, going from just over 500,000 units being available to almost double that number since 2023. So that is a positive trend. Maybe certainly that should provide some relief to buyers in the housing market. The red line is for Massachusetts, and the axis is on the right. And here, there's less of a positive trend. The number of homes on the market, if you look at the scale here, I'm not seeing as big of a positive trend. If you ignore kind of the peaks and valleys from the seasonality, maybe there's a slight uptick in the number of homes available, but not quite to the extent as in the U.S. Okay, that's quickly on the housing market here. Let me just share some projections and then a perspective on sort of trade and fiscal policies. So the big question mark, no one really knows the answers to these questions, is how will the trade situation get resolved? When we're done with this 90-day reprieve, 90-day period during which we're supposed to be negotiating deals, the threat is that if we do not reach a deal by the end of the 90-day period, we go back to this very punitive, extremely high reciprocal tariff rates. And so that's kind of the incentive to get a deal done during the 90-day period. Will we have deals done? I certainly hope we do. I'm not sure that anyone really knows. We had some announcements made about a deal with the UK, and then sort of a 90-day period with China, during which negotiations will happen. And I think there's some optimism that we'll get to a good place there. What will the ultimate situation look like? No one really knows. But here's one possible scenario. What if, at the end of the day, let's say later in 2025, we end up with the following situation, which is that we have 30% tariffs on all imports from China, and then we have 10% tariffs across the board on all other imports. So this is kind of one simple scenario that some folks think there's some likelihood of this happening, just given what we saw happen with the UK trade announcement, for example. So that seemed to set as a baseline like a 10% rate. So some people think that that's a sign of things to come, that every country is going to have to accept the fact that there's going to be a base 10% tariff on all imports. So will that happen? A lot of uncertainty there, but that's what some commentators think may happen there. China may face an additional sort of penalty on top of the 10% having to do with kind of fentanyl production or whatever issues. Who knows what will happen as a result of negotiations. But some people think something like this may be where we end up. And this would represent a much higher tariff rate than we had before 2025. Before we entered this year, tariff rates were much lower. And if we end up in this place, it'll be a much higher tariff rate. what could the impact be? So this is where economists and different companies are, trying to estimate, if this is what happens, how will the economy be impacted here? So these estimates are kind of coming out as we speak, folks doing analyses. And we're seeing things like, hey, global output could be impacted negatively by 1%. And that's a recent JP Morgan estimate that I saw from last week. There's a bunch of economists at Yale trying to model different scenarios. And they're saying if something like this is what happens, U.S. prices will be higher by 1.5%. So meaning at least temporary inflation that'll increase the price level. And then real GDP for the U.S. will be lower by negative 7 percentage points. So that's kind of early estimates of what the impacts could be. So some increase in prices and then a decline in GDP. Enough to get us into a recession? No one really knows. There were recession calls being made last week that were dropped after we got the positive announcement about the China trade deal. So I think that remains to be seen here. Real GDP growth declining by 0.7 percentage points. If we take that at face value, that's not enough to put us into recession yet. But certainly it's a negative development, and this is with lots and lots of caveats and assumptions built in. This is assuming that the trade situation gets resolved in a favorable way by the end of the 90-day period. If that does not happen, then I think all these bets are off here. The other thing to watch that will have a major impact on the economy is fiscal policy. So I think right now there are negotiations being done on the Hill on a tax bill. The most important element of which is that it'll try to extend the individual income tax provisions of the 2017 tax cut, similarly with the business tax provisions, and maybe some modest cuts to discretionary federal spending. Not enough to make a meaningful difference in terms of the overall deficit level, but maybe some modest amounts of cuts to discretionary spending. So if that happens, again, there's a question mark. There's uncertainty around whether this will happen as well, what the final tax bill will look like. But the isolating the fiscal policy alone, there might be a small positive impact from extending the tax cuts and positive pro-growth impacts from business tax provisions. And then what is the net impact here? So if the trade situation gets resolved later this year and the Congress is able to pass and the president signs into law a new tax bill, what's the net impact? And so here, it might be something close to a wash. So this is where it's really hard to make hard predictions here. We need far more data and details on these policies, but it's possible that there's a modest negative impact from the trade policy, and then an partially offsetting positive impact from fiscal policy that gets us to something close to a neutral impact on GDP. And that's just a very early kind of perspective on this that will need to be refined as we go. A couple of final comments, and then we'll conclude and invite questions here. A couple of the Federal Reserve banks make real-time projections about current quarter GDP. So as they get more data over the course of a quarter, they're making real-time projections about what that quarter's GDP might be like. And so this is done by two Federal Reserve banks, Atlanta and New York, and they're both saying kind of something similar here. So as of kind of end of last week, late last week, based on all the data that Atlanta Fed had at that time, they're projecting something like a 2.3% GDP growth in the second quarter. The New York Fed independently does a similar analysis, and as of May 9th, last week, based on all the data they had at that time, they're projecting a 2.4% growth in GDP for the second quarter. So both are projecting that GDP growth this quarter should be pretty robust. Now, we still have a month and a half to go here. Who knows what will happen, and these projections will be updated to reflect kind of new data over the course of the quarter here. But I showed some data that is consistent with strong underlying strength in the economy still, mainly having to do with consumption. So somebody raised a question, hey, was this all people kind of like, try to make their purchases ahead of the tariffs coming into effect? And if so, another thing to think about is, well, maybe all the purchases were done in the first quarter, and if that leads to a drop-off in purchases in the second quarter, that'll be a negative thing. So if we see monthly data on retail sales declining as reflecting something like that, then that'll be factored into these estimates, and that'll reduce projected GDP growth second quarter. So that'll be really interesting to see how much of a timing thing is going to impact consumption and GDP growth this quarter here. I almost didn't include these projections here. These projections will be revised. This is the most recent projection from FOMC. One perspective on this is what the FOMC was projecting in March before some of the announcements in April, some of the uncertainty really substantially increased. This is what they were thinking. If trade policy and fiscal policy roughly offset each other in terms of impacts on the economy, maybe something like this could still be a base case expectation. So that's one sort of rough way to think about this. GDP growth, modest, a little below 2%, both this year and 2026. So no recession, but modest GDP growth here was the projection from the Fed. Unemployment rate, current levels rising slightly to 4.4% 2025 and kind of maintaining that level in 2026. Inflation, not quite at Fed's target in 2025, but getting very, very close, maybe almost there in 2026. And this is why I think in their estimates, the Fed funds rate, the policy rate would stay higher this year, maybe come down a little, but higher than they would be long term because the fight against inflation continues. But they're saying we're going to get there in 2026. And the Fed funds rate, consistent with that policy view, is in the final bottom row there. So these were the projections. That was my last slide. Oops.
Jason, you still there? Well, it looks like Jason is having a little bit of a technical issue. Hopefully he comes right back. Tony, is he having a bandwidth issue?
We lost him.
All right, well, we'll give him a minute to come back because we do have a couple of questions that came in just now. So let's give him a second. Saba, if you are on the call, I think you are. If you could help Jason reconnect, that would be great. Or call in. The good thing is it was at the end of his presentation. He was wrapping up. So hopefully he's back in a minute. It does look like he's still connected, Tony, is he?
No, it hasn't timed out yet. That's gonna disconnect because there's no data behind it.
Okay. Well, that's unfortunate, but I'm sure he'll be right back. It's just, again, he did just wrap up his presentation and was wrapping up with his summary. So I know, I just want to make sure we can get a couple of these questions answered. And if you have any questions, this is the time to send them over while we have a minute as we're waiting for Jason to reconnect. I know there is someone on the call from FHLBB that's in the audience. So hopefully he ran into Jason's office to help him reconnect. But yeah, oh, there he is.
There he
And
is.
there's Saba. Hi, Jason. I said there's no better time for you to time out than at the end of your presentation. So
My apologies. Sorry about that.
Don't worry. This is what happens. No problem.
Yes. So if I could just make one concluding comment here and in the remaining time. Yeah. So here's a quick summary here. When I was asked, I'm the planning guy at our bank, and then at our board meetings, we're talking about, hey, what are some possible scenarios here that we should think about? And as you might imagine, I'm sure this is what's happening at your credit union as well, which is we just have to consider multiple scenarios. We look at a recession scenario where rates do a certain thing and business volume moves in a certain way. So I kind of present a base case alternative scenario for those types of scenarios. And then somebody could ask, hey, what if we have stagflation, right? So we have an inflation problem doesn't go away. So I talked about one reason why we could have such a situation here. Housing is a challenge. If the housing inflation doesn't go away, that's going to add to pressure on overall inflation. And if tariffs add to that, compound that problem by increasing the pricing level, so there's multiple pressure points in inflation, could we end up in a stagflation scenario? So economic output isn't doing great. Consumers pull back on spending, while inflation continues to be a problem. Well, we haven't had a problem in 50 years, but could we get there? Possibly. And so we model a scenario like that. And so I think that's how we're approaching it. So the bottom bullet here is the key point for many of us corporate managers, which is we really ought to consider multiple scenarios: recession, stagflation, business volumes, going up and down by different amounts. That's how we're approaching it here. I imagine that's how many of you are approaching it as well.
So, Jason, we did have a few questions come in, so I'm just going to shoot them at you right now while we're
Absolutely.
still within the time. So, if the proposed policies take effect, things like tariffs increase, taxes kept low or decreased, and reduced government spending, what is the effect on the federal deficit?
Not a lot. I think federal deficit, if you look at all the projections that I'm seeing, the federal deficits will remain elevated for years to come. So that's the projection that I'm seeing out of sort of neutral congressional budget office type places that look at this. I think the spending, there are some very modest spending cuts, but nowhere enough to really make a meaningful difference in terms of the overall deficit level. And I think extending all of the tax cut provisions. So the base case currently, before there's a new bill, is that some of the tax cut provisions will sunset, and then we'll see an increase in revenues. So that's kind of the base case that people are working off of. And if we extend these tax cut provisions, we're dropping revenues quite a bit. And whatever cuts we're seeing on the spending side are not nearly enough to make a meaningful difference in terms of reducing deficits. So I think deficits, at least currently, we're expected to see continue over time. Can there be enough external revenues? Because we're raising tariff revenues. If we impose 10%, 30% tariff, that means that we're getting revenues on the tariff side. I don't think those numbers are big enough to reduce deficits kind of in a big way, given what's happening on the tax side, on the spending side.
Okay. Another question that came in is, what do you see as the biggest economic challenges facing Massachusetts in the next 5 to 10 years? For example, cost of living, housing, or workforce development?
Yeah, all of the above. I did show one chart that I said I found a little surprising, which is a drop in employment year over year in the Boston metro area.
Right.
I wasn't expecting to see that. Why is employment dropping? So that's something that I kind of want to understand a little bit better. I show some data on sectors. So cost of living issues, housing prices, and then being able to sort of grow kind of the economy in Massachusetts and attract new workers, new folks coming into the state. That I love to see that continue to happen here. That is a challenge elsewhere in New England, just given the demographics, industry makeup. Some places in Maine, for example, and other places are having real challenges with cost of living and attracting industries and employment. I hope that doesn't happen. I hope that we're able to sort of remain in a strong place in terms of attracting employers and workers into the Boston area. And if you have challenges on that, that'll be one of my biggest concerns, I think.
Okay, so that kind of ties in with another question that came in about what you think the biggest weaknesses of the Massachusetts economy are right now. So that kind of ties in.
Yeah, very, very similar. I think I didn't share this data here, but if you look at which cities are growing, which cities are growing their employment, we had a decline year over year. Many other cities are not. And if you rank kind of cities across the U.S., the pattern is, I'm sure familiar to the audience here. Many cities in the South and some in the West are attracting workers, attracting employment, and then even actually New York City is actually growing in employment and industries. And so when I saw kind of Boston and Massachusetts being on the other side of that, there was a little bit concerning. I imagine a lot of that has to do with the usual factors, cost of living,
Right.
I think that's a major factor here. Just housing affordability is a real challenge.
Okay, if anyone else has any questions, this is the time to take advantage of Jason being with us. Just we'll give a minute, but just to, thank you so much, Jason, for being here again. your time and your expertise. You know, it's just really important right now, given what's going on. So thank you for all the knowledge and the insight. And we really appreciate that. No more questions. So that's going to conclude today's presentation. Jason's presentation, the slide deck is available upon request. The recording will be ready to be viewed again early next week. And please keep an eye out for future programs coming in. On June 3rd, we have a webinar, Serving the Underserved the Right Way and Increasing Loan Growth and Profitability. On June 10th, we have Mastering Your Image, Branding Strategies for Credit Unions. We plan to be adding more webinars. And again, if you have any topics that you're interested in hearing about and looking into, please reach out and let me know. We design these for you, and we want them to be relevant and useful. So again, Jason, thank you so much for your time today. We really appreciate it. And yeah, everyone have a great day. Thank you. Take care.
Thank you very much.